Hi, everybody. Welcome to the Long Distance Real Estate Investors educational webinar today. I'm so excited about our guest speaker today. She is one smart cookie. I'll get into that here in just a bit, and she's got a great topic to share with us. If you're just joining in on an educational webinar for your first time or listening in, my name's Jennifer Ward, and I'm one of your hosts for the group. A little bit about myself, I live in Denver and I've been investing in Indianapolis for the last 3 years. And also I have with me my lovely co-host, Raina Bias. Why don't you introduce yourself?
Hi, I'm super excited about this topic as well. So I also live in Denver, not very far from Jen. I'm a former attorney and I left to be a full-time real estate investor in November 2019. I do primarily the Burr method and invest in Memphis and Birmingham as well.
Awesome. Yeah, I'm so happy to have Raina with me co-hosting. She brings up great questions for our guests, and she brings so much value to our community. So thanks, Raina, for doing this with me. All right, so now let me do a little introduction with our guest tonight, Rochelle Delia. Rochelle and her partner, her husband, in fact, to be more specific, they have founded Housing Joint Venture. It's a real estate education and development firm, and they're helping other professionals explore their income property ownership as a safety net to diversify or create wealth for their future. So they're doing great things, have grown drastically. They started out with a $300,000 real estate portfolio, and that is now worth well over $2 million in 3 years. So they're doing something right. And she comes from a chemical engineering background. We have Dr. Delia here to be specific. So, Rochelle, why don't you share a little bit more about yourself?
Absolutely. And I'm so happy to be on the show today. And we were chatting just before we came on that we all are graduates of UT Austin. So hook 'em horns.
Hook 'em.
If there are any other former Texans, watching this evening. And funny enough, I actually started investing while I was in Austin in graduate school.
Wow.
So as Jen just mentioned, I did get my PhD in chemical engineering. And, PhDs take a really long time. Okay. And they suck. So much so that people literally pay you to do them. And I was like, well, I'm going to be here for over 5 years. And since I am getting paid a pittance, but paid nevertheless, it makes sense to go ahead and at least attempt to purchase a home. And that was actually one of the reasons why I chose UT Austin as opposed to some of the other wonderful institutions, because I could at the time afford to be a homeowner on a graduate student salary in Austin. Now, of course, we are talking a couple of years later at this point, and that's probably no longer the case. But at that time, I feel very fortunate to have gotten in the game then. And, that's essentially how it got started. I bought a little 2-bedroom condo in Austin, rented out the spare bedroom to my apartment mates. And that really just got me biting the bug. And from there have really taken off. And so now I live in Columbus, Ohio, with my husband, and as Jen mentioned, so I did own that property in Austin, and so I did do some out-of-state ownership and management for a while. Since I've sold that, but definitely still doing a little bit of long-distance investing in the sense that we are in Columbus, Dayton, Toledo, as well as Detroit, Michigan. So happy to take this conversation in a variety of ways and areas, and certainly happy to share with our other real estate aficionados.
Yeah, awesome. Well, thanks so much, Rochelle. So the topic tonight is we're talking about investor archetypes.
Mm-hmm.
So what we mean by investor archetypes is going towards the more intrinsic side of things tonight, looking at your qualities, your strengths, your weaknesses, and seeing how those fit in all the various investor strategies that are out there and promoted today. I have personally really been thinking about this the last couple months, particularly as I've been battling another flip that I end up dreading. And it's just, and I've just kind of come to the maybe conclusion that I don't know if this is the right strategy for me. And not so much, because it's not going to help me reach my real estate investing goals. I'm sure it would, but it just has caused me a lot of grief, headache, and I think it's a lot to do with just my personality and what's required of that strategy. And they're just not a great fit. So what got you starting to think about investor archetype and educating people on this particular topic?
Yeah, I think that's a great question. I think all of us get started with what feels like, I'll say, the shiny object, or what feels the most immediately accessible to us. But after a while, you have the benefit of reflection after you've taken action, right? So the first hurdle is to take action and actually get in the game. And then after that, you can kind of reflect and say, okay, how can I do this better, more strategically, so that I can get further, faster, and more efficiently? And, so my path is very similar to yours. I did not start out with flips. I did start with buy and hold, because I always just like the idea of doing something one time and reaping the benefits for years and years to come. So buy and hold was always attractive to me. But buy and hold is not one size fits all. And, I'll fast forward just a little bit. By the time I met my husband, he was also a real estate investor and developer in his own right. And just because we both did buy and hold, and we both did the buy ugly, renovate, and rent it out, it didn't mean that we went after the same properties. Not even a little bit. As a single guy, he went to some more challenging neighborhoods than I felt comfortable going to as a, 5'3" and 110 pounds soaking wet, even in my mid 30s. So, the things that made me feel comfortable as a place to invest were certainly different than him, even though the strategy from a higher level was the same. And then I think a lot of people always try to find, how do I find a good deal, or what's the best place to invest, and what's the best city? And after a while, you're like, I think these questions are all symptoms of a larger problem, which is us just not thinking about the problem at a higher enough level, which is really, are we being as strategic as we should be, or are we just being opportunity seekers? Are we just kind of chasing the next shiny object, or are we stepping back and saying, what are my strengths? What am I legitimately good at? And then how can I leverage that? I'm a huge advocate of thinking that everyone has an unfair advantage. And it's really a matter of just figuring out what your unfair advantage is, and then how can you, I'll say, exploit it for your own benefit, right? And so that's really what got me thinking about these things. That this shouldn't be that hard. How can I make this easier? And how do different people take the same strategy and really implement them in different ways?
Absolutely. Yeah, I think you nailed it right on the head. So, and I love that everybody has an unfair advantage, because we got to just identify that, tap into our strengths, because even the people who feel like they experience the most challenges in life, they have something that can help them get ahead. So,
right.
Absolutely.
And I love that it's all about harnessing who you are inside, like your true north, like who you really are. There's that one saying that's like, you can only be yourself because everybody else is taken. So what are you bringing to the table? I love that. And I love that as a starting point.
Yeah.
Yeah.
And
I love that, Raina. I don't know if I've heard of that one before. I can't believe it. Yeah, I love it.
Yeah, that's wonderful.
Yeah.
Like when you think about a SWOT analysis, SWOT, and I was just looking for a slide, and I don't think I have that one up just as yet, so I'll have to go look for it. But basically, when you talk about a SWOT analysis, there's both internal and external attributes that you can weigh and kind of decide. So from a corporate America standpoint, they're always trying to determine how they can really leverage the channels, the sales channels they're already in, the product mixes they already have, in order to really expand their market share, so forth and so on. So how can we do something similar on an individual level? So a SWOT analysis is strengths, weaknesses, opportunities, and threats. And strengths and weaknesses are really focused on you as the individual. So what do you have as a strength? What is a weakness that you would think about that you may have? So as an example, at the top, of this segment, you mentioned that my background is in engineering. So that means that I should be decently good at math, right? So when we talk about, real estate investing, there's a little bit of math there. There's some finance, there's some money going around, some dollar signs. So that's definitely one of the strengths that I have, is more of the technical financial analysis, building models and that sort of thing. But a weakness can be, typically engineers can be a little on the shy side. And so when you talk about things like negotiation, I personally feel that being a property manager and the operations side is really customer service at the end of the day. And so I really had to work on my communication skills, being much more comfortable with difficult conversations, and being willing to hold my ground. And sometimes where I personally may have felt hesitant before really building up those skills, right? So those are weaknesses that I had that I've chosen to invest in and invest in improving. Now, when we talk about what's external, that'll be the opportunities and the threat side, so the other side of this, 4-quadrant spectrum. So as an example, opportunities can be things like economic or market conditions. So, and a threat is a similar thing. So we are still in a pandemic. It's like not this never ending thing. I don't really know where to say we are. So it feels like we're on the tail end, but then it just keeps popping back up. So somewhere we're still in a pandemic. And so that is an existential threat, right? So that's this larger entity that has nothing to do with us as an individual. It has nothing to do with we didn't do anything individually to cause this, but it's something that is a threat to our own personal portfolios and portfolio growth. Okay, so that can be a threat, but it can also be an opportunity. Why? Well, because some people have had difficulty in maintaining employment, then that means that some programs like the Section 8 program is now experiencing a huge surge in applicants. So as a residential landlord or a person who is on the buy and hold space, if you choose to accept Section 8, then you're going to have, not that Section 8 already did not have a plethora of tenants and more tenants than houses available, but that supply and demand side is really going to be in the residential landlord's favor. And really being able to command, I can choose who the best resident is going to be for this property because there's just so much demand for it. So that's an opportunity that if you choose to take advantage of it, it can really give you great headwinds or tailwinds, for your growth. Similarly, you can say, hey, some people may not have been paying their mortgage. So if you want to purchase something below market value, that's another opportunity that'll be coming our way in the next 6 to 12 months. So really and truly, there's no situation is really necessarily bad. It's all about the way in which you position yourself and your mindset towards it.
Yeah, definitely. I mean, it's really all about, your perspective, your outlook on life, and being able to hopefully try to see things in a more positive light and how to work it towards your advantage. And then, but doing that within, the parameters of your strengths and weaknesses, and hopefully that equals success.
Yeah. And just to add another layer to this investor archetype, and we can talk about, some of the actual labels that I've given to them. But to add another layer, I think the people that succeed the most are people that are very cognizant and really go out of their way to be a planner. And the way that manifests itself in a field like real estate investing isn't having a business plan. And I know you're like, oh my God, snooze fest. Who wants to have a business plan, right? I know, I don't either. But ultimately, it's about planning and really saying what is going on both individually as well as externally, and then how can I strategically say, if I hit this situation, what will I do? What is going to happen? And then how do I want to position myself? It's a lot easier to take action once you've already thought about those hard situations before it's in reality. You don't have the anxiety, you don't have all that additional gunk that's making it very difficult to have clarity. And having a business plan, and really just, as I mentioned before, not being an opportunity seeker and really saying, how can I be as strategic as possible to get to that end goal? Is that early retirement? Is that just having, trust fund babies? What does that look like? And there are no wrong answers. You can create whatever you want. We have our own paintbrushes, but what does that look like? And how can I back calculate my way to get there?
When you talk about a business plan, I think that's brilliant, right? Because a lot of starting out real estate investors don't necessarily have a business plan. It seems kind of like one of those things where you're supposed to learn how to do it in MBA school and then nobody ever actually does it. And I was kind of running up against that as well when I first started. But what I did then was basically, it's like literally 3 lines, and all it is like my criteria for buying. And once I sat down, it was something like it clicked, and I was like, okay, now I have a framework, even though it wasn't like beautiful. I didn't have like, here's a summary of my objective strengths. At least it had my criteria, and then I was on the go.
Raina, you hit the nail on the head, and that's exactly why people, tend to like work with us. It's because, and funny enough, a lot of people that have MBAs, which I don't really, I don't have an MBA. I'm like, why are you hiring me? But whatever. But, the funny thing about it is, back to this like corporate America example, because I think it's something that a lot of people can resonate with is, in corporate America, they build business plans for every investment they make internally or externally, whether it's an acquisition, investing in a product line, expansion, what have you. And it's all based on key performance indicators. And so it's like before they even say, we're going to make this investment or not, they already know what is the ROI and what is that time frame that any investment I make has to pay off. Is it going to be a capital expense, right? Is it going to be a capital investment, or am I going to be able to expense it, just as my normal like daily operations? And then what kind of time horizon do I need to have before this is even attractive to me or not? With real estate investing, people are like, I'm going to realtor.com. I'm scrolling through. I love these countertops. Let's do it. I'm jumping in with both feet. And I get it. Yes, you need to take action. Action is wonderful. But you're dealing with many dollars with lots of zeros. And so it probably makes a lot of sense to think twice or maybe 3 times about it before jumping in with both feet. And so that's what, that's all a business plan is ultimately, is what are your key performance indicators? How do you leverage that with what your strengths are? And then really having that action plan for how can I grow and scale it over time? And, it's so funny, it doesn't really matter what the business is. Just having gone through the process of actually writing down what those goals are, it's so interesting. I hadn't looked at our business plan since I wrote it. And I was like, oh my goodness, this actually happened. And like kind of for the better, like wow. And it's just, I think there's really something to the subconscious level of saying, this is where I want to go and this is what I want to do. And really being as concrete about it. So not, oh yeah, I kind of know. No, like put it on paper, write it down, type it out, actually have it there.
I am so glad you just made that last comment. Put it on paper, write it down, type it out. I am guilty. I have not done a business plan for real estate investing, but I have done one before for a company or a business idea. And I'm so glad I did the business plan because I decided not to pursue it. And I ended up pursuing real estate instead, even though I haven't done a business plan. But I do want to point out, like, you don't have to have an MBA, or a business background to put a business plan together. I actually took a free course that our community offered in Denver. It was actually geared towards women wanting to get into business. They offered a free course for you to do your business plan. And so it was like a structured course. I went once a week for, I think about 8 weeks. And it was so enlightening and so helpful. If you go to the Small Business Administration, they have either free or low cost business plan courses. And the best thing about these resources in all of our communities that I'm sure if you live especially near a large metropolitan city or even a smaller city, who really want to support their local businesses even more, they're probably going to have resources like that community resources to help entrepreneurs. So this is definitely a kick in my rear and I will do it.
I'm going to kick a little bit harder. Can I share my screen?
Yeah.
Let me share my screen. I want to just bring it on home just a little bit.
Yes. Let's get into the meat. Yes. Thank you.
Yes. And this is just a couple of slides I'd like to share. So basically what we're talking about is, real estate is investing. It's simple to understand, right? That's why you don't feel you need a business plan, because ultimately I'm going to buy a box. I'm going to put people in the box and they're going to pay me every month. That's pretty much how it is, right? I'm going to take an ugly box, I'm going to paint it and make it pretty, and I'm going to sell it because it's prettier. Like this isn't complicated stuff, right? But it's the actual implementation. That's where the rubber hits the road, and that's where all the nuanced details and actually the hows and how to actually make this work. That's where people fall short, right?
Yes.
And here's just some data for you that when I first looked this up, I was just so taken aback. So first of all, we should all pat ourselves on the back because only 7% of Americans that file their taxes, so people that file a 1040, declare any rental income at all. And this is from the 2015 IRS data. So that means 93% of the population isn't even in real estate at all, like not even zero rental income. So we're already ahead of the game. So kudos to us. But here's what gets really interesting. Of that 7%, only 7% of those persons have property valued at over $1 million. So most landlords only own one rental property. They don't have scale, they don't have multiples. And you ladies are in Denver, so this may not necessarily translate, but certainly, in the Midwest, if you're going to get over $1 million, that is certainly 3+ units, if not more, and I'm being very generous because a lot of our properties are well below $100,000, right? And so it's really about the 7% of 7% that are able to replicate real estate investing to the point where they can actually scale it, right? So that is 0.05% of the population that has income producing property that is valued at over $1 million. And so it's like, in order to scale and really see how you can make your portfolio grow, it's what does this 0.05% do that most other people don't? And it's exactly what we were talking about. It's being very data driven and very cognizant of how they're spending their money and how they are investing over time. And when we talk about growing a large portfolio, the reason why it's so difficult is that real estate investing is actually 7 different business plans, 7 different businesses in one. Like, we're actually crazy because we're doing strategy. We're actually doing acquisition. Financing is this entire separate industry. The construction industry is this whole separate industry. Just rolling her eyes like, yes, it is. Absolutely. Right. Building a team. And I mean, every business owner outside of real estate can tell you building a team is a non-zero task and extension of energy. Property management, a whole separate industry in and of itself. And then asset management and scale over time. So we as the individual landlord or individual investor trying to grow and scale and do all the things, no wonder we're like burnt out and tired and can't grow. We're trying to do 7 different businesses at the same time and just putting one blanket term on top. And so the way that you can not have so much, I'm going to call it chaos, is by saying, okay, what are my metrics? What kind of acquisition targets do I want to have beforehand? And I like to focus on both financial and non-financial KPIs, right? So I think we spend a lot of time talking about the financial KPIs. And don't get me wrong, that dollars make the world go round. But a lot of times we realize that there's more to the story, particularly in real estate, than just the numbers, right? And so again, really talking about this conversation of being an opportunity seeker versus a strategic investor. So let me see here. When we talk about our investing KPIs, again, there's 2 different segments. We have the financial KPIs and the non-financial ones. So, financial KPIs, you can set whatever ones that will get you to your goal. I like to use some of the more popular rules of thumb. So if you're familiar with the 1% rule, that means that you are gaining 1% of your gross investment every month as income. 2% rule, same thing. So for 2% rule, I would be on a $50,000 property or $50,000 total investment. I would need to earn $1,000 per month, right? And I can tell you from my experience that when properties meet the 1% rule, they generally break even unless there's some sort of large repair. So a water heater, roof, that sort of thing. Other than that, they're going to break even. And so you're not going to have to come out of pocket for it every month, which is a good thing. The 2% rule, though, that's for people that are really kind of like myself and like really about the cash flow, right? So they're going to have sufficient income remaining after all those fixed expenses to have a profit at the end of the month. So for persons that are on the, I want to retire and I want to eat off of this, then they're going to want that higher financial return as opposed to a lower one, right? But again, it totally depends on your strategy and your investor archetype, which we can chat more about, right? But then another thing that I think is often missing from the conversation is this concept of non-financial KPIs. So this is why going to, I'll say, some more challenging or neighborhoods that are systemically underdeveloped, that's why they can be, while from a financial standpoint, they are like a money gun, like just spitting cash out. But actually to receive that it can be very management intensive because of those non-financial KPIs. So who are the demographics? Who's living there? What kind of jobs do they earn? Do they have? What are their transportation access to transportation and individual transportation they may have for themselves? What kind of infrastructure is there? So infrastructure is something that we don't often talk about, but Jen, you're investing in Indianapolis. That's very similar to here in Ohio, where we have 100-year-old buildings all over the place. And, you start talking about, cast iron plumbing, you start talking about needing to upgrade electric, and, this little fix and flip can really do a number on your wallet, right? And it's really about what kind of buildings are there and what kind of infrastructure is already in place. Hello, Flint, Michigan. Like, these aren't things that we can just ignore, because that really is going to factor into our financial bottom line, as well as the type of person that's going to live there. And from a management perspective, are we able to provide them the proper customer service that they're going to need over time throughout the lifespan of that investment? And then also, of course, appreciation potential, because that is a wonderful cherry on top. I personally choose not to invest strictly for appreciation, but I mean, let's be honest, who doesn't like a big payday? Those windfalls really allow you to upscale your portfolio in a way that, a onesie twosie is just not gonna move the needle in that way. And that's the honest truth. So I think that's really everything that I want to talk about in that regard. One of my favorite websites for getting a lot of this more demographic information is citydata.com. I'm seeing some head nods, so you're probably familiar with it already. It is an aggregator of census data. And so basically it really allows you to really get some of those macro perspectives on a neighborhood, on a localized area. And so that's one of the places that I love. My husband is city and regional planner by background as well. So we have a lot of other, I guess, more nuanced places that we search for data, but, citydata.com will get you a really good head start and much more thorough than most investors do. So you'll be ahead of the curve for sure. And then, of course, we mentioned the SWOT analysis before. And so SWOT analysis is about not only, your internal and your external perspectives, but overall, what kind of resources do you have available? And that could be financial resources, personnel resources, friends, family, all the things. Also, just your personal comfort level, like it's okay to admit that you're tired. I admit that I'm tired. I'm tired of being an individual landlord, and that's okay. So does that mean that real estate's not for me anymore? Not necessarily. It means it's time to grow and scale up the portfolio. That's the answer, right? And so one of the things that I've come to terms with is, unfortunately, earlier this year, my dad had a health event, and so I was his caregiver for a large part of the summer. And so I'm just so grateful that we had so much cash flow that I was able to just basically drop and run. That's a blessing. At the same time, I realized, wow, I am tired and I kind of want some more of my life back, right? And that's okay. So now that just gives you the opportunity to make more decisions. Does that mean you go back to hiring a property manager? Does that mean I now scale up to a larger holding, reposition the portfolio? What does that mean? And so being honest about your comfort level, it's okay. It's okay to say, you know what, I did this and I changed my mind. Or now my perspective is bigger and I know more and I can really go into a different area than I originally thought. And there's nothing wrong with that at all. Right. And I think that's one of the beautiful parts about real estate is that, I get bored easily. Real estate has not, it's been 12 years and I'm not bored yet. Isn't that crazy? It's an amazing asset class. I really do love it. And then of course, I think this goes without saying is how aggressive you want to be in your own portfolio growth. Right. So some persons want to be slow and steady. When I started out with that little condo in Austin, I was like, you know what? I want to have 10 single family houses that all rent for $1,000 a month. That is $10,000 coming in. That is a worthy goal. That is what I want. And that's a worthy goal. There's nothing wrong with it. Until I bought an apartment complex, when I was 27. So, we already beat that goal. And so you're like, okay, so now what am I going to do when I've reached my goal already? Right. And it can kind of cause a little bit of an identity shift of, wow, this is who I thought I was, but now I'm given the opportunity to grow. Do I want to grow or do I want to stay? And again, that's a personal choice, right? There's nothing wrong with buying a trophy property and paying it off and riding off into the sunset. Beautiful. There's nothing wrong with saying, you know what? Real estate ultimately is a leverage game. And if I'm not using other people's money, then really what am I doing? Also, very fair and a very worthy path to go down. So, it really does go down to, what are your strengths? What are your weaknesses? What kind of perspective do you have? And where is it that you're trying to go? And how can real estate be packaged in a way to help you get to that destination? So I think that's everything that I wanted to share from these slides. Yeah.
I had a couple questions for you, if you don't mind. So
Yeah,
it
absolutely.
sounds like it's kind of, tell me if this is fair to say, but it kind of sounds like when you are creating a business plan, you're looking at your archetype, which I know we haven't talked about yet, and I know you have like specific ideas, so we could, I definitely want to talk about that, looking at your archetype, creating a business plan. And then kind of what it sounds like too is that once you start moving on your business plan and there's action, when you hit those uncomfortable spots, or like, I guess, I don't know if I want to say uncomfortable spots, maybe roadblocks, or maybe something's jutting up against your, like what you like doing, or a reevaluation of your life, you're then at that point realizing that you're outgrowing the business plan that you wrote, and then creating a new sort of business plan.
Absolutely.
Okay.
A business plan is a living document. You're not creating handcuffs for yourself. We're all doing this by choice, right? Nobody's forcing us to invest in these brick babies. That's what I like to call them, brick babies. Nobody's forcing us to do this, right? We are ambitious ladies on this call, but we're ambitious people who are like, hey, this is an amazing opportunity, and why not take advantage of this? And so it doesn't mean that you have to stay stagnant. There's a how when you're at the bottom of a set of stairs and you're standing there and you're looking straight ahead, you can see rung maybe 1 through 3. But as you go forward and you take that first step, now you can see rungs 2 through 4, 3 through 5, so forth and so on. And that's exactly how businesses in general and real estate investing, so much so, is that as you go, you gain more clarity, you gain more just clarity. I think it's just the perfect term. That apartment complex I was telling you about, when we started, we were just going to be landlords. We had just a little blog like everybody else. We were just bloggers and, talking about our journey, whatever. But, here's what happened. So a few things. First, my husband had a little house over in a transitional neighborhood, and he rented it out, and he and the family was moving in on a Saturday, and it was a single mother and her children. When they moved in, he was there, to give them the key or whatever. The little boy ran in and said, he had not seen it before. The mom did all this on her own. She came in and the little boy was like, Mom, this is so much better than our last house. I'm so happy to live here. Cue tears, okay? Just saying. Like, oh my God, right? Point number 2, that little apartment complex that I got, it was a complete abandoned shell at the time of acquisition. So boarded up, it had previous flooding, just a total eyesore in the community. Total eyesore, just bleh. Okay. We renovated it, got people in there, blah, blah, blah. One Saturday morning, I don't know why these always happen on Saturdays, but whatever, life goals. Work-life balance, put that in your business plan. That wasn't in mine, put that in your business plan. So there was this one Saturday morning, and I was going to change an air filter. As I just got the filter, and I was like, I can just drop it off, whatever. And everyone was doing totally normal stuff. The dads are outside washing the cars, children are playing back and forth, the moms are like sweeping their back porches or whatever. Everybody's doing normal stuff. Nobody's paying me any attention. But it just hit me. This is an entire community. And if we hadn't taken, I'm going to say, the risk to go out and say, hey, I can see a better vision for this place than it currently has today, then this entire community would not exist. And for us, that's definitely where real estate transitioned from so much more than, I like to say, just numbers on the balance sheet, to recognizing that, we create places where people's lives happen. Like, we're literally housing providers. Like, we create community on the individual family level, as well as, from a larger standpoint as well. And, I like to say that I can't think of anything that is more selfless than saying, I'm going to put my own personal livelihood on the line to make sure that I can have housing or create housing for someone else. So I think that all the work that we're doing is incredibly important and incredibly beneficial. And so I have lost my train of thought as to where I was going with this, but long story short, we are awesome. And I'm sure it'll come back to me after that.
I love that your perspective on that. And I guess I never personally, I mean, I've always had the goal that, I want to provide a nice, safe home for our tenants, right? But I guess I never thought that from the perspective that I was like putting my livelihood on the line, because you are, like whether you're using your own money or other people's money, if things go south, it puts you in jeopardy, and can be a setback. Maybe not, where you're just totally at ground zero, but certainly it's very feasible to be a setback. So I love and then, it's just like, and then sharing that message, because, I think it's especially talking to people who aren't in real estate investing and explaining about what you do. There's always that scummy slumlord, impression that everybody seems to have about people in real estate. Like, oh, you must be a slumlord automatically.
Right.
So
or you're taking advantage of people, like you're a bad person. It's like, no, we are the original social entrepreneurs. Like, I don't need no app to be a good person and be a cognizant, conscious business person. No, like that fundamentally is what we do.
Absolutely. So thank you for that reminder or that awareness, even just for me, my initial awareness of, that we are putting our livelihoods on the line. And what was that last thing you said? Like the original, like social contributors.
Social entrepreneurship is, it's a buzzword. It's something that everyone is trying to get into.
Love that.
You don't need to try to get into it. We already are.
Yes.
We already are. Fundamentally.
So anybody watching this, go back to your friends and family, colleagues, whoever made that remark, and say, you know what? I'm the original social entrepreneur. I'm here building up the community. What are you doing?
Exactly. Exactly. Because think about it. We are really talking about America here. We as a country are really going towards a renter nation. Some people by choice, some people not by choice. That's a whole nother conversation there. But housing and housing affordability, that's not only an American issue, that's a global issue at this point, and then again, at this point, we're September in 2021, inflation has not yet caught up with us. So we're still in this kind of lollygagging phase. But when it does, some people are going to be very rudely awakened about supply chain, the cost of goods and services, and really the value that is provided. And, I think our political climate likes to make things very adversarial when, in my opinion, they're not necessary. And it's like, if landlords and property owners and real estate investors, from the flippers to the wholesalers, the whole 9 yards, if we don't do what we do, then every abandoned home will stay abandoned. Okay. Every house or every building that is of poor quality will stay of poor quality. All the economic development that people enjoy with their Starbucks and their, Jamba Juice and all these wonderful things that we all love, that fundamentally is real estate development. That is forward progress. And that has to come from somewhere. And a lot of times we as the individual investors, we are that first mover. I if you can't tell, I really like to have mental models when it comes to these things. And let's talk about when a neighborhood is transitioning and you have, let's say, a depressed neighborhood and when it goes through the gentrification process, and we can talk about how to prevent that and all that, but just for conversation's sake, if you have a undervalued, ugly, abandoned house, the bank is not going to lend on it because property values are too low. So the bank can't make any money. And there's not enough equity there for them to have any protection. So they're not going to touch it with a 10-foot pole. So the only persons that can invest there are persons that can buy in cash, right? So who buys in cash? Investors buy in cash. And that can be your cash, somebody else's cash, tomato, but somebody has to come with some. Okay. So if you start buying up those properties and you start renovating them, putting investment into them, making it desirable, okay, now I'm changing the whole ethos of not just this individual building, but this entire neighborhood. And one of the things that we like to do is apply basically the same market maker approach that the stock market employs, where they create a market where it did not previously exist. That's exactly what we do in real estate. So if you can buy multiple buildings on the same street in the same neighborhood, so forth and so on, then now you set your own comparables. Once I set my own comparables, now I'm changing the entire ethos of this neighborhood. So now I can attract higher income residents, and you can choose to rent it. Therefore, you don't support gentrification because you're not selling and, pegging to higher property values. Or you can sell, that's a personal choice, how people want to run their businesses. But regardless, you're going to get a restoration of vibrancy. You're going to get all the beautiful parts that come with development. And we all love forward progress. And if you don't have that first mover, the first mover comes before the flippers, comes before the big developers, all that. If that first person doesn't say, you know what, I see more here than just this ugly little boarded up house, the whole thing stops. It doesn't exist. It's not happening. The whole train doesn't even leave the station. And so I think that people don't place enough value on the role that the individual investor plays. The mom and pop investor, Wall Street can only follow. They can say, oh, hey, there's yield here. I'm going to go and follow. That's what they do. They don't test the market. They don't create the market. They follow and expand on a market that's already been created. And we are the market creators. That's why we're awesome.
I love that. I absolutely love that. And it also, there was that study done, and I can't remember which book I read it in, but it was basically like, if you make sure that the street lights aren't burnt out, that windows aren't broken, that kind of stuff, it actually reduces crime, and people, reduces graffiti, reduces crime. And so that's kind of what you're doing in that neighborhood, a potentially depressed neighborhood that had a lot of blight. That's what my real estate agent calls it. He's like, you got to take care of the blight.
Yeah, it is a blight. That's exactly what it is.
He has that southern accent. So you take care of that blight on that street, and all of a sudden there's just a new fresh air coming in, and less crime, and more of a community, and people are outside. I love that you say that.
Everybody loves safety. Everybody likes security. Right. Okay. Everybody wants to sleep soundly at night.
Yeah. The grass everybody wants mowed, and it makes everything look nicer. House prices are, the value of people's homes are going up. I love that.
Everybody wants peace of mind. Like, who doesn't want that? It doesn't matter what neighborhood you're in. Like,
well, but
don't sleep at night. I don't want that.
But if we want to circle back though to the investor archetype, however, I do have to say, like, there's plenty of investors who that may not be their right move to be that initiator, and that's perfectly fine. Yes. And that's all about connecting back to your strengths, your weaknesses, what your life situation is at that time. And it's okay to jump on that bandwagon once another investor got that neighborhood going and started, buying a turnkey from them. If that's perfectly where you at in your point in life, that is totally okay. And we don't need to be comparing ourselves to, the initiators per se, but everybody has their strategy that's a best fit for them at that time. So,
and that stage in life, like at this point, I'm in my mid 30s now. We're going to start a family soon. So, like the things that I would do when I was younger are a little bit different than the things that I value now. Time is much more important to me than than what it was before. No more Saturday mornings. I'm not doing those anymore. Right.
Yeah. I'd love to hear about the way that you've delineated the archetypes, because I feel like you are very systematic and have a very systematic approach. I love it. And so, yeah.
Yes, I'm a nerd. I am sorry.
Well, you're a PhD.
I'm proving it too. I'm proving it.
You have to go into the research. You have no choice. So now it's ingrained in you after finishing your PhD.
So at high level, I like to think that there are 3 to 4 different investor archetypes, and I didn't come up with this on my own, hubby, if you're listening, it was a we, not a me. Okay. So I have to put that in there.
Yeah.
Ladies. So, I would say the first mover person, that is what I call the cash flow king. So that's a person who says, you know what, I am maximizing cash flow pretty much above all else. So I don't care about appreciation. I don't care if this thing doesn't raise 1 penny from the day I purchase it to when I sell it. All I care about is what is the yield that my money is earning me. So at that point, it's more of a comparison to what other avenues do I have for passive, and of course, passive income is really just a tax designation, right? So air quotes.
Thank you.
Air quotes.
That should be a whole other topic.
Right.
What is passive income?
Right. That's a whole nother webinar.
whole other can of worms.
Right. But when you think about return on investment, okay, so now I have the stock market, I might be able to do some derivatives like options or Forex or something like futures trading or something. But, so you have those things. You have life insurance, like the cash value accumulation, whole life insurance options. Of course, you have regular bank savings accounts to give you 0.0001% and things like that, right? So where am I really going to get the best return for my money? And so from a cash flow perspective, right now we're definitely at the very aged end of the expansion phase. So very much in the end of a mature market. But generally speaking, when you're in the recovery phase where you're coming back out, you can really get some really nice cash on cash returns or overall cap rates that really make it where, these things are printing money. Like we talked about the 2% rule, here, especially in the Midwest, you can certainly get 2% rule. You can get 3% rule, especially while before everyone realizes that you can. Because again, at this point, all of our fundamental economics are out the window and everyone's just looking for more yield. So what that means practically is if you're a cash flow king, then you're going to have to go to smaller and smaller markets. So you're not going to go to the primary cities, those A players, your New York, your LA, your Houston, your Chicago's, those are tier 1 cities. You're not getting cash flow there. It's not happening. I'm sorry if you live there. No way. It's exactly why you, as someone that lives in Denver, is going to invest in Indianapolis. You're going to a second tier market, right? And the way that our economics are going out in an American, economy today, the tertiary markets are really the new frontier. So, we're in Indianapolis, a Columbus, a Memphis, while those are second tier markets and have been great for the last decade, now we're going to smaller cities, so think like your Savannah, Georgias, your Camden, New Jersey's, your Springfield, Ohio, your Dayton, Ohio. So these places.
Terre Haute, Indiana.
Terre Haute, Indiana. Exactly. Hello, Rose Holman. Like, exactly. Like that's exactly where you have to go if you're seeking these sort of things. So not that these, that you can't still find it. It's about going where your money is treated best. So that really is the ethos of the cash flow king. So I think that's good. The solid returns seeker is the one level down. So this person is like, cash flow is important to me. 100%. Cash flow is important to me. Asterisks. I'm willing to sacrifice a little bit of cash flow to get some more, I'll call it management stability. So I want a nicer neighborhood. I want to have better school districts. I'm willing to pay a little bit extra to have, I'll call it, I don't know if peace of mind is the right wording, but a more stable resident base that has additional income and they have disposable income. So if I want a resident base that has more disposable income, then I'm willing to accept lower returns for the operational efficiencies and ease that I'll gain from that, right? So that's a solid return seeker. So cash flow king is like dollar.
Or queen.
Or queen, exactly. Dollar among all else. Cash is king or queen. Solid return seekers like, you know what? I'm gonna go a little bit, a little bit down.
Yeah.
Then you have this like blend who's like, I like cash flow, but I actually need some appreciation so I can get some big wins at bat. Okay. And so this person, they like to invest in what I like to call the path of progress. So they'll really rely a lot more on that larger data. They're going to be looking at the city and development plans and really seeing where is the overall city going so that I can be well positioned to take advantage of some of that appreciation. So those persons are the folks that are like, I just need to cover my costs or maybe lose a little bit every month. But ultimately, I want a blend of having a little bit of both. So I want to have some big hitters on my board so that I can really level up my portfolio from time to time. So again, they're willing to take on a little bit of a short-term cash drain because the ultimate payoff will pay all those short-term losses with just a couple of handsome profits. So that's really where they are. And then the last person is an appreciation aficionado. This person is like, I am the opportunity seeker. Okay. Like, look, I want to just make as much money as I can. And I want to gamble a little bit for it. And I'm playing the appreciation game all the way. So I like cash flow. That's nice. That allows me to pay my bills. But it's not the end all be all. And I would love to have the trophy properties, that maybe don't earn me as much, but it's worth a lot. So you could say this would be more of not necessarily Donald Trump's model, because he does actually more of a licensing type of thing, but we'll go with that just for perception's sake. Like, I'm going to have trophy properties in these amazing locations that are worth, buku dollars. And I really don't care what they earn every day, because this is $1 million property and you're dumb for not owning it. So that is the appreciation aficionado. They're really playing, and this works really well, obviously, in commercial, where you can do that a forced appreciation a lot more than what, just a residential property can do, like an individual single family house or a double type of thing.
Yeah. Do you by chance have a slide listing all of those?
I have a cheat sheet, a little PDF cheat sheet.
Okay. Yeah.
Yeah,
Can you
so
display that real quick? I would just love to take a screenshot of it.
Absolutely. And we can put it in the chat and allow folks to download it.
Yeah, or that would be great. I'm a visual learner, so I'm like, oh, what was the one she said before? Oh, this is good. This is good.
Hopefully you can see this. This is part of a little training that we have.
Right.
And so cash
flow king, solid, and then we'll
solid return
seeker.
Yep.
Okay.
And I got a little typo here at the top. So this is our cash flow appreciation blend. So that's what this one is. And this last one is our appreciation guy. So he's like, I'm going ultimate, a little bit of speculation.
Aficionado. And what was the one before that one? That
was cash flow appreciation blend. I got a little typo here where I have the title.
Oh, I gotcha. Okay. Got it. I was like, oh yeah, I thought I already saw that one. Okay.
Yeah. So a little bit of a typo here.
I love how you've broken it down in your own terms, but but using the common terminology within real estate investing, and then I'd like to take people to take another step and say, okay, let's go back to my strengths and weaknesses, and let's pull this together into a business plan. Like, which strategy is going to pan out best for me at this time in my life?
Right.
And I think that's so
important. And be gentle with yourself, that stage in life can change.
Right. Oh my goodness. I mean, I can't tell you I've been investing technically since 2007. That's when I got my first own rental property, a duplex outside of Austin, Georgetown. And I had thought I was managing that from a distance on my own. It was my first time ever to have an investment property. And I, for whatever reason, didn't hire a property manager right away. And I got so burned out. I said, okay, I'm done. No more. I sold it. I'm never doing it again. and then fast forward, not even a year later, we're looking to do a live-in flip that we want to then sell, after we fix it up. Well, then we decided not to sell it, and we kept it as a rental property because we learned about the market being so fantastic for rental properties and cash flowing. So you just never know where you're going to be, even 6 months ahead. Especially, who would have thought with this pandemic, how our lives would shift in such a short period of time. So it's a big wake-up call, right? Of that your trajectory will always change. I've learned this year, my motto is never say never, because you just don't know how you're going to progress, how your strengths, your weaknesses, your lifestyle is going to change, because we're all evolving individuals. We're human, and that's what it's all about. So I would encourage people to look at your archetypes, almost on a biannual basis, and say, is this where I had originally defined myself? Is that where I am now, or want to be next year? And you've probably evolved to one to another, and you could kind of see those archetypes as a stepping ladder, Sure. I would kind of see maybe the one that is more conservative with their cash flow. I'm looking for more of the stable tenant situation, being the first rung on that ladder, then the cash flow king, because now you've got some experience, you're ready to take on a little bit more riskier tenant level. And then you're all right, I've got some solid cash flow to support me. Now I can take some even more risk and dabble into appreciation. Yeah. And then, you're at the the last tier of, in my opinion, risk level, and you're just gambling, you know, and hoping that, I
Right.
mean, with some research, you know, but you're smart gambling, you know,
Absolutely. I
and
couldn't
betting
agree
on that.
more.
Yeah, but then there's also people who like maybe they are at that last tier of appreciation and their life has changed and they're ready to take a step back. They need a breather, you know, and they just want something more stable, you know. So it's all a life cycle.
And we're getting close to our
Yeah.
hour. What it sounds like, so I know you have a coaching program. So how do these
Yes.
archetypes go into your coaching program, and how do you get people to figure out where they are?
Absolutely.
Yeah, absolutely. So our program is really geared to help people go from that opportunity seeker to strategic investor. So we help them from the beginning. First of all, when we're talking about our archetypes, that also makes sure that you understand where your finances currently are. And I think some folks, not that you don't want to look at it, but looking at it from the lens of I am now taking on somebody else's household as my financial responsibility, which is a lot different than can I pay all my bills and do I have credit card debt? Like it's a very important nuance. So things like that. We help people really determine what those goals are and get very clear on their vision, mission, and goals. So not just saying, oh, I'm just going to invest in real estate for whatever. No, you're creating an investment firm. And then now how can I actually make sure that this firm is going to serve my life and my lifestyle all the way throughout? And then we spend probably the majority of our time really focusing in on those key performance indicators. So a lot of it is we have a lot of templates and a lot of guides to really take it off of the individual. So it's not so much work. It's really, this is a proven path. And then how can I customize it for myself and really make sure that I am building a firm that is really additive to my life? You know, a lot of people will build a business and it's, you know, you can build a ladder and then you realize it's leaning up against the wrong building. Mm-hmm. And that's really disheartening because you spent so much time, effort, and energy to build this up and like, I'm here. I don't actually want to be here. Right. And so that's really where we spend a lot of our time. So yes, we go into all the tactics of everything of property management and construction and all the things. And, you know, some of the more, I'll say sexy topics, like how do you leverage the cash value in life insurance and IRAs and creative financing and all the things. But really at a high level, it is how can I not be just an opportunity seeker and just trying to find a good deal, you know, almost like a rabid search or hunt that I feel a lot of people are on, and really saying, no, I'm going to flip the script and say, this is my rubric. And now I'm just screening properties that earn their right. They earn the right to be in my portfolio. I'm not chasing anything. Now I'm screening you and only the best have earned the right to be in my portfolio. So that's what we do.
I love that. They've earned the right to be in your portfolio and you're not conforming to them. I think that's so important.
Very, very important.
Because you wouldn't want to do that with people, right? Think of properties as people. They've got to conform to you.
You know, we're all ladies, you know, when you were in the market for a husband, most of us have a list. Okay. I had a list and it was very helpful when I was dating. And very similar.
Why does that not surprise me? Like that kind of doesn't surprise me.
Yeah. Yeah. Have your rubric.
So how are people going to find out more about you and kind of whether or not this program fits with you? And
absolutely. Well, you can certainly find me on LinkedIn. That is my most prolific of all the social platforms. You can certainly visit our website at housingjv.com, or if you're interested in the bootcamp specifically, it is theinvestingbootcamp.com. So certainly you can go there and find me on all the social medias.
Awesome. Do you have like a snapshot of all those, or should we put those in comments?
You can put it in the comments. And then I also have it in that media page I share with you. So they're all there.
Okay. Well, I will share the link for the media page when we go or air this recording. So
yes, Rochelle Delia. So it's like Michelle and Rochelle together. So R.I. and last name is Deli with an A on the end.
Oops, I didn't. And then I'm sorry, what was the other ways they can find you? I know you on your media link, but I'm just going to put the
investing.
websites.
Theinvestingbootcamp.com and then Housing JV. So housing joint venture. And so if people are interested in learning about some of our development opportunities, like where they can invest with us, or on the education side, both of those are on housingjv.com.
Okay,
Yeah.
so I just got those up there. So if anybody who's tuning in on this when we stream this, they can go to those websites, and then I'll also provide the link of your bio, which I think is a great idea and probably something we all should do as real estate investors. So, especially when we want to market ourselves to other lenders and other
Yeah.
partners, people to potentially partner with. I think that's just a really
Mhm.
smart idea. So,
Absolutely.
yeah, well,
couple-
this has been so awesome.
So awesome. And you've really motivated us. And I hope our audience is write a business plan,
Yes.
be true to yourself on who you
Mhm.
are, recognize that there's a social justice thing happening when you are a landlord and you can take responsibility for that and
Mhm.
have that motivate you, which is awesome. And then, yeah, and then if, taking action and just making sure that you get a solid idea and moving forward. So those are great takeaways from this
Yes.
interview. Thank you.
My goodness, it has been my pleasure. I love this conversation. It was so much fun. And dare I say, I love chatting with real estate ladies as well. So
Yes.
it made it
Always.
just that much more special.
Yes, absolutely. I agree. I have male speakers too, so but
Like I said, just made it more
all-
special.
It's
Just
a
more
little special when it's all ladies, I have to admit. So I can't, I'd be lying if I didn't say that. So yeah, well,
All the
Rochelle, we're
giggles.
gonna have to have you come back on
Please
because
do.
obviously
I'd
you
love
have a
that.
wealth of information. I love your perspective.
Mhm.
I'm not a PhD, not even close. But I appreciate like the data-driven mindset, the research, that goes into things. That's how I got into my journey of long distance investing. I was like, all right, I got to figure out a system to where to put the pin, I might do it a little bit different today with some experience now that I have, but yeah, I love that, just that way of going about things, of looking at the data and the research and the analytical side of real estate investing. So
Mhm.
I'll geek out with you.
Yeah, let's do it. Let's do it. Let's do it. And
Yeah.
of course, that's not to say that there's obviously you want to see things with your own two eyes, so we're not advocating people to just invest with clicks, but definitely a little more rigor and due diligence on the front end, I think can save a lot of headaches on the back end.
Yeah, do some soul searching. Absolutely. I mean that I'm so glad you came in at a right time in my life when I was really diving in, doing some soul searching about my investing journey
Mhm.
and how that intersects with my lifestyle today. And I think this is a great message that people should learn from the get-go for
Mhm.
sure.
Yes.
So
Thank you so much for your time.
yes.
Oh, thank you,
Thank
ladies. I
you.
really appreciate it.
All right. Take care.
Take care.